The U.S. market is in its pre-session, and Nuburu Inc., ticker BURU, is already showing extreme volatility. It's currently trading at 44 cents a share, which is a jump of 11.15% before the opening bell. This follows a flat close in the last session on Friday, where it finished at $40. Now, when any investor sees an 11% pre-market pop on a stock, the immediate expectation is that a major catalyst has been announced, a huge contract, a buyout offer, or a stunning earnings report. But with Nuburu, the reality is far more complex and significantly more speculative. That 11% move is happening in a vacuum of major, company-specific news today. Instead, this price action is the symptom of a much larger, ongoing story. A company with fascinating technology that is attempting a radical, high-stakes pivot away from its core business, all while battling massive financial dilution and the persistent threat of delisting. The expectation is that this 44-cent stock is a lottery ticket. The reality is that it is one of the most speculative, news-driven, and dangerous stocks on the entire market. Let's establish the common ground. It's very easy to get excited about the story of Nuburu. This isn't a company selling sugar water. Its foundational technology is in high-performance blue lasers. This is genuinely advanced stuff, designed for high-speed, high-quality metal machining, welding, and 3D printing, with applications in batteries, medical devices, and electronics. The general belief, especially among traders on the Robinhood app or those discussing SoFi stocks, is that this technology is groundbreaking and that the stock, trading for under 50 cents, is just overlooked. This belief has been supercharged by a flurry of press releases over the past few weeks. The company has announced a transformation plan, the creation of a new subsidiary called Nuburu Defense LLC, a binding agreement to acquire an Italian software firm named Orbit, and just last week, a new strategic alliance with Maddox Defense to create a joint venture for building advanced military drones for NATO. But here is the critical challenge to that belief. This transformation plan is a near-total pivot away from its core laser business. The company is essentially becoming a defense and software holding company, funded by an endless stream of dilutive financing. While the press releases sound impressive, projecting $100 million in annual revenue from the drone JV by 2028, or tapping into a $500 million order portfolio from an affiliated company, Techne, the financial reality is brutal. In September, Nuburu raised $12 million in a public offering. The price? 0.1428 cents per share. They also issued a staggering 126 million common warrants, with an exercise price of just over 17 cents. This is the definition of massive shareholder dilution. Just look at the financials. The company makes less than $1 million in revenue. Its gross margin is negative. Its net profit margin is negative 400,000%. Shareholders have been and continue to be substantially diluted. The 11% pop you see this morning isn't institutional Fidelity wealth management advisors buying in, it's retail speculation on a stock that trades millions of shares a day based on headlines. This recent trading activity is the entire story. On Friday, the stock traded over 20 million shares. Its 52-week range is a stomach-churning 12 cents to 98 cents. This isn't online investing, it's high-speed speculation. The stock is a favorite on investing sites that track penny stocks because it offers absurd volatility. A single press release, like the drone JV announcement on October 22nd, can send the stock soaring 25% in a day. The next day, it can just as easily collapse. This volatility is compounded by its compliance issues. Nuburu trades on the NYSE American exchange, which has a minimum bid price requirement of $1. The company has been in and out of compliance all year. On June 9th, shareholders approved a proposal to authorize a reverse stock split, a move designed to artificially boost the share price back over $1. They also approved increasing the authorized share count from 250 million to 900 million, giving the company a blank check to issue and sell hundreds of millions of new shares, which is exactly what they did with the $12 million offering. Let's briefly touch on the business model, or rather, the two business models. The original Nuburu, the one that went public, is a pioneer in blue laser technology. Blue light, having a shorter wavelength than traditional infrared lasers, is absorbed more efficiently by metals like copper and aluminum. This is incredibly useful for welding components in electric vehicle batteries, a market you'd think would be booming alongside Tesla stock. The problem is, Nuburu has been unable to successfully commercialize this. Its revenue is almost non-existent. This failure led to the new transformation plan. This new model, being executed by its dual CEO, is to use its public stock as a currency to acquire other businesses, primarily in the European defense and software space. They are acquiring Techne, Orbit, and forming a JV with Maddox. So, are you investing in a blue laser company or a European defense tech holding company? The answer is both, and neither is profitable. This creates an almost impossible to analyze future outlook. There are two scenarios. In the bull scenario, the one traders on the Robinhood stock trading platform are betting on, this pivot works. The drone joint venture actually secures NATO contracts. The acquisition of Orbit, a SaaS company, provides a stable, high-margin revenue stream. The company's executive chairman, who owns Orbit, successfully integrates these new pieces, and the 0.14 share offering in September is seen in hindsight as the smart money financing that fueled the turnaround. The stock, propelled by a short squeeze, Fintel reports a high short borrow fee, rips past $1, regains compliance, and investors who bought at 44 cents look like geniuses. This is the narrative that drives the 11% pre-market gain. Then there is the bear scenario. This is the one that Fidelity or Schwab Intelligent Portfolios would model, and it's not pretty. The transformation plan is a desperate last-ditch effort from a failing company. The acquisitions are of related party entities, the chairman owns Orbit, and don't generate immediate, meaningful, or clean revenue. The core blue laser business continues to burn cash. The only way to fund these new ventures is by printing and selling more and more stock, which they are authorized to do. The 900 million authorized shares mean that current investors could be diluted into oblivion. The company will be forced to do a reverse stock split, perhaps 1 for 20 or 1 for 40, which almost always results in the new higher stock price bleeding back down. In this scenario, the company is an investment black hole, and the 11% pop is just meaningless noise in a long-term chart heading to zero. This is the very definition of a high-risk gamble, not a traditional investment. It is not a stock for a Fidelity IRA or for anyone who needs investment help for their retirement. This is a stock for speculative day traders using Interactive Brokers platform or a Fidelity mobile app to scalp small profits from high volume. It is a stock that has more in common with Robinhood crypto trading than it does with buying Apple stock or Nvidia stock. It is a pure headline-driven gamble. Given the nature of this stock, I have to ask, are you one of the traders playing this volatility? Comment below and let me know if you are holding BURU and what your price target is. To summarize, the 11% pre-market jump in Nuburu is the market's expectation that this chaotic, rapid-fire transformation plan will actually succeed. The expectation is that a $52 million market cap company can successfully pivot into a defense and software powerhouse. The reality is that this is a company with near zero revenue, negative margins, and a business model funded entirely by printing stock at fractions of a dollar, relentlessly diluting its existing shareholders. It is a battle between a compelling story of advanced technology and a horrifying balance sheet. This 11% move is pure speculation, and anyone considering online investing in this name needs to understand they are not buying a business, they are buying a press release. Disclaimer: this content is for informational only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Bang! If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.